Have you ever watched some people who seem to climb the ladder of wealth with surprising ease, while others are constantly fighting just to stay in the same place? Today, we are going to completely unpack the fundamental building blocks of smart investing and look at some truly practical strategies that you can start using immediately. By the time this guide is finished, you will possess the core knowledge needed to make investment choices that genuinely resonate with your personal goals, your comfort level with risk, and your specific timeline. Before you even think about committing any capital to an asset, the absolute first step is gaining a crystal clear picture of exactly what your financial objectives are. You need to seriously consider if you are setting aside money for something that's happening relatively soon, like finally purchasing that new vehicle or planning an amazing family getaway, or if you are aiming for those massive, distant milestones, like achieving financial independence or a comfortable retirement. Your entire investment methodology must adapt and shift dramatically, depending on whether your time horizon is short or incredibly long. For those shorter-term needs, the wisest path usually involves sticking to decidedly lower risk instruments, such as high-yield savings accounts, insured certificates of deposit, or dependable government-issued bonds. These safer vehicles are fantastic for preserving your principal and offering solid stability, though they naturally come with more modest growth potential. Conversely, when you are targeting long-term wealth creation, you gain the freedom to explore assets with significantly higher growth trajectories, including individual company stocks, broad market index funds, or even carefully selected income-producing real estate. The central concept you must master here is the ever-present trade-off between the level of risk you accept and the potential reward you might earn from that decision. Now, let's dig into the crucial topic of managing the inevitable risks that come with growing your money. One of the most consistently repeated errors we see from investors just starting out is the failure to adequately acknowledge and plan for potential market downside. It is an undeniable truth that investments offering the highest potential returns frequently bring along a great deal of price volatility, meaning markets can swing wildly in either direction without warning. Truly understanding your personal comfort level with seeing your money decrease in value is absolutely essential for your long-term peace of mind. Ask yourself very honestly, how would I genuinely feel if my entire portfolio value dipped by 20% over the course of just one single month? If that mere thought causes you significant anxiety, then sticking to fundamentally safer investment classes will almost certainly be the better and more sustainable path for you. Furthermore, the powerful concept of diversification stands out as perhaps the single most essential tool in your entire risk mitigation arsenal. By deliberately spreading your capital across many different asset types, various industry sectors, and even different global economies, you drastically lower the probability that one single negative event can completely derail your entire financial journey. Building upon that idea of spreading things out, let's concentrate our focus on the sophisticated concept known as asset allocation within your portfolio. A thoughtfully constructed, balanced portfolio should naturally incorporate a thoughtful blend that includes a healthy mix of equities, high-quality fixed income, real estate holdings, and sometimes those specialized alternative assets like precious metals or digital currencies. Generally speaking, investors who are much younger and possess a very long time horizon until retirement can comfortably afford to lean more heavily into stocks because of their historical tendency to deliver superior growth over multiple decades. In contrast, individuals who are older or who are nearing the point of needing to draw an income from their investments should prioritize more stable assets like investment-grade bonds or reliable dividend-paying stocks to safeguard capital. Regularly performing a process called rebalancing your portfolio is key to ensuring that your existing mix continues to accurately reflect your current financial goals and your evolving risk tolerance as market values naturally shift. Let's now shift our attention to two of the most popular vehicles for growth: individual stocks and exchange-traded funds, commonly known as ETFs. When you purchase a stock, you are literally acquiring a fractional piece of ownership in that specific company, which obviously comes with the highest potential for spectacular returns, but also significant price swings. Investing in single companies successfully demands rigorous due diligence, a solid grasp of their reported financial health, and a constant awareness of developing market narratives. Exchange-traded funds present a considerably more streamlined and accessible route for most market participants looking for growth exposure. By acquiring just one share of an ETF, you are instantly investing across a pre-selected basket of many different underlying companies, which effectively spreads your risk while still allowing you to capture overall market upside. These fantastic funds can be specifically designed to target particular economic sectors, geographic regions, or even contemporary investment themes, such as sustainable technology or renewable infrastructure, giving you incredible flexibility. Another exceptionally powerful strategy that has served investors for centuries is the direct investment into physical real estate property. Property ownership offers the potential for two distinct streams of return: reliable income generated from tenant rental payments and long-term appreciation in the asset's underlying value. One key difference is that real estate is a tangible asset you can physically touch, which provides a significant psychological comfort level for many people compared to paper investments. However, this asset class does bring its own unique set of responsibilities, including handling property maintenance, dealing with tenants, and accepting that the investment is generally much less liquid than a stock that can be sold in seconds. For those new to this sector who want the upside without the hassle of being a landlord, looking into real estate investment trusts, or REITs, is an excellent starting point to gain exposure. We must also take a moment to thoughtfully consider investments that fall into the category of alternatives, which includes tangible items like precious metals or volatile assets, like various cryptocurrencies. These non-traditional holdings can serve a valuable purpose by helping to further diversify your portfolio, because their prices often move independently from the general stock and bond markets. Crucially, these alternatives carry their own distinct and often higher set of risks, so thorough, dedicated study is absolutely necessary before you even consider allocating any meaningful portion of your hard-earned capital toward them. Especially concerning cryptocurrencies, their volatility is famously extreme, meaning prudent portfolio construction dictates that only a very small speculative percentage should ever be allocated here by most sensible investors. Shifting gears slightly, let's zero in on the non-negotiable aspect of planning diligently for your eventual retirement, irrespective of your current age. Consistently contributing funds into tax-advantaged retirement vehicles, such as the 401k or IRA plans, available in the U.S., unlocks significant tax benefits and harnesses the incredible force of compound growth over time. I cannot stress this enough. Even consistently small contributions made very early in your working life have the mathematical potential to grow into substantial nest eggs over the span of several decades. The sheer, unbelievable power of compounding interest working on your behalf is arguably the single most effective mechanism for passively accumulating significant personal wealth as the years accumulate. Beyond your asset choices, the daily financial habits you maintain play an equally important role in reinforcing your investing success. The most successful long-term wealth builders are invariably disciplined, consistent savers who diligently maintain a working budget and actively monitor where every dollar is being spent. A major focus must be placed on aggressively eliminating high-interest consumer debt, as the interest payments alone can completely wipe out any gains you might achieve in the stock market. One automation trick that guarantees consistency is setting up automatic, recurring transfers into both your primary brokerage account and your dedicated retirement funds, ensuring you invest regardless of the day or market noise. Maintaining steadfast emotional control is just as vital as any technical investment skill. Learning to resist the powerful, ingrained human urge to panic sell during market dips is absolutely crucial for realizing long-term capital appreciation. A significant, often overlooked component of maximizing your overall net returns involves proactively understanding the various tax implications associated with your investment structures. For instance, in the United States, your upfront contributions to certain retirement accounts can be tax-deductible today, while you will eventually pay capital gains taxes on profits realized in standard taxable brokerage accounts later on. Other countries offer their own highly advantageous structures, like the UK's ISAs and pensions or Canada's RRSPs and TFSAs, all designed to shield growth from immediate taxation. Taking the time now to plan your investments with tax efficiency in mind can easily translate into saving many thousands of dollars over your investing lifetime, allowing you to reinvest more of your hard-earned profit. In a financial world that is constantly evolving, making the commitment to stay thoroughly informed through continuous education is simply non-negotiable for the serious investor. Make it a habit to regularly consume reputable financial news. Endeavor to deeply understand the nature of various market cycles, and learn how to interpret basic company earnings reports when they are released. Please be extremely cautious and avoid the temptation to blindly follow investment tips or speculative pronouncements that originate solely from unverified social media channels or unknown online personalities. Ultimately, a solid foundation of knowledge is what truly empowers you to make confident, deliberate decisions that are perfectly synchronized with your own unique long-term objectives. Finally, let's discuss the bedrock of all successful investing: cultivating the proper mindset centered on unwavering patience. Building substantial wealth through the markets is fundamentally a marathon endeavor that demands consistent application of discipline and adherence to a tested, clear strategy over many years. Developing and strictly maintaining a genuine long-term perspective is the single best defense mechanism you have against making costly, reactive mistakes during periods of inevitable market choppiness. Remember this core truth: unwavering consistency in your regular investing schedule will almost always outperform any frantic, failed attempts to perfectly time the very top and bottom of the market cycle. To efficiently summarize the path to financial success, your approach must integrate careful initial planning, rigorous risk management, strategic diversification across assets, precise allocation, and a commitment to ongoing financial learning. When you thoughtfully combine all of those strategic pillars with truly disciplined saving habits, a keen awareness of tax optimization, and that crucial ingredient of patience, you are positioning yourself perfectly for significant, sustainable financial growth. By diligently applying these proven investment principles with consistency over time, you will gradually and steadily accumulate capital, significantly lessen everyday financial anxiety, and successfully reach those major life milestones you have set for yourself. Whether your ultimate dream involves retiring early and traveling the globe, finally purchasing that first piece of investment property, or simply guaranteeing a secure and comfortable lifestyle for your entire family, these are the steps that get you there. Truly understanding these core strategies and then committing to implement them thoughtfully means you are doing much more than just following passing investment fads. You are taking definitive, proactive control over the trajectory of your entire financial future.